Hey everybody, this is our third video on how to read your income statement as a business owner. So we've gone through what the P&L is, how it's used, and what the structures of it are. So now we're going to talk about how to analyze it. And there are generally two ways that you can analyze an income statement. That's with a vertical analysis and a horizontal analysis. So let me just parse over to my notes. The vertical analysis is where we look at every line in the P&L going down, so vertical, and we compare them to a base number so that they're all at a common size or a ratio. Generally, we're going to use revenue as our base number, so we're going to divide every other number in our income statement by revenue. So Cogs are going to get divided by revenue, gross profit will be divided by revenue, operating expenses will be divided by revenue, net operating income will be divided by revenue. By doing that, we're going to see what every single one of those lines is as a percent of revenue. That's going to give us like a better understanding of how each dollar of revenue is being apportioned out into the business and allow us to follow it as it flows through down to the bottom line. So that's the first type of analysis. What's beneficial about the vertical analysis, we get to see what the makeups are of the different costs. It's going to allow us to say, okay, well, 30% or whatever of COGS is a little high for our industry. Why aren't we more efficient there? Or our people costs are 50% of our revenue. Maybe that's a little bit too much and we need to trim that down, etc. So that's the first one. The horizontal analysis is where you look across your income statement at different periods. In this case, we're going to look at different months. With a horizontal analysis, a lot of people call it a time series analysis. We're going to be comparing months against each other. Again, we'll use the same thing. We're going to use percentages and we're going to use actual amounts. So we'll be able to see if our COGS or costs or revenue go up or down by actual dollar amounts each month. But we're also going to track how much they change as a percent of revenue. What it helps with is seeing patterns, seeing trends over time. Any kind of time series is going to allow you to see how things change in different slices of time. So that's really beneficial to help us understand if the business is getting better or worse in different areas. So remember, we've got vertical analysis, which is going to let us see how the dollars flow through the business. And that tells us whether we're overweight or underweight on, certain expenses and certain margins. And then we're going to look at horizontal analysis, which will tell us how each one of those things are performing over time in a trend. So let's go ahead and jump into this income statement. So here we have Chris's profitable service business. And this is the same P&L as before, January through September. And what you'll notice is there's been a couple more lines added, right? So what I've done is I've gone in and I've added these margins or these percentages between every line in the income statement. And the way that I calculated that is I just take whatever the account is that we're looking at. So in this case, it's project revenue. And then I divide it by the corresponding period total income. So we'll see that 50,000 divided into 80,000 is 63%. So hopefully that makes sense to you. Then we're going to look at the same thing for monthly services revenue and then other income and on down the line. So let's take a look at January of 2020 to do our vertical analysis. So we saw that 63% of our revenue was generated from projects and 38% of our revenue was generated from monthly services. We had nothing in other income, and that got us our income of $80,000. Obviously, 80,000 divided by 80,000 is 100%. Now let's look at our COGS. If we look at our contractor COGS in the month of January, our contractor COGS were 8% of revenue, and our employee COGS were 58% of revenue. So when you take those two things out, you get our total cost of goods sold. And when you take that from revenue, you get our gross profit. So our total cost of goods sold in January were 65%, and our total gross profit was 35%. The way I interpret this is that of every dollar of revenue that was brought in January, 65 cents went to paying our contractors and our employees in billable work. And then we kept 35 cents of every dollar in order to cover our overhead and pay our non-billable employees. Now let's look at our operating expenses. We see 16% of revenue went to people cost, 4% of revenue went to occupancy, 5% of revenue went to sales and marketing, 1% of sales went to professional services, and nothing went to other. So doesn't look too bad there. It seems like, based on the industry, those don't seem totally crazy. What we do see, though, is that total expenses ended up being about 26% of revenue. So really quickly before we scroll down, if we know we only have 35 cents left at the gross profit line and we've spent 26 cents on total expenses, then the difference should be our net operating income. In this case, 9%. Now we're going to look at other income and other expenses. We didn't have any other income, so that's 0%. If we look at other expenses, we did have $300 in other expenses. As you can see, that's pretty nominal as a percent of total sales. So we basically ended up with about 9% of net income. So the way I translate that again is that of every dollar of revenue that came into the business in January, 9 cents ended up being in our bottom line, in our net income, again, before tax. That's how you do a vertical analysis. But the power of these two different analyses is by combining them. So before we jump into combining them, let's talk about horizontal analysis. Again, horizontal analysis is going across. It's also called a time series. That's where we look at individual accounts and their performance over time across periods. If we look at January, we can see that project revenue in January was 63% of total revenue. In February, it was only 22%. In March, it was 23%. In April, it was 17%. In May, it was 63%. In June, it was 33, 29, 35, and 39%. In total, it ended up being about 39% of revenue. Pretty interesting. If you actually scroll over these and you look down at the bottom of your Excel, you'll actually see some averages and counts and sums done for you. So if we look at our average in Q1, it was 36% of revenue was from project work. In Q2, it was 38%. And then in Q3, it ended up being 34%. So slowly becoming less and less of the total revenue in the kind of a quarterly trend. Then we can look at monthly service revenue the same way and see what percent of revenue it made up. It's going to be the corollary for the most part to project revenue to get to that 100%. So 59% of revenue came from monthly services. Again, we saw it being about 64% in Q1, 63% in Q2, and 63% in Q4. So holding pretty steady there. And then other income, we had this one other income charge in September that made up a significant portion of our income in September, about 10%. So that's how you do a horizontal analysis. And what we can see from project revenue and monthly services already is that about 60-40 monthly services to project for this business, right? So that gives us an idea there about our revenue mix. Then let's look at cost of goods sold. So if we look at contractors and we look at employees over time. So we see in Q1, contractors made up about 8%. In Q2, they made up 19%. And in Q3, they made up 17%. So if I'm seeing these contractor costs jump up from 8 to the 19% range, that gives me a question about how we're structuring our service business. So are we relying too much on contractors, or is that a move that we've made to create a more variable workforce that's a little bit more nimble in case work dries up? So it kind of depends on the strategy of the business. Now let's look at our employees who are billable. They're about 60% of revenue in Q1, about 49% of revenue in Q2, and about 40% of revenue in Q3. So we are seeing that as our cost of contractors goes up, we aren't having to hire as many people. So we're seeing that our employee costs are coming down as a percent of revenue. Now the question we have to ask ourselves is, long term, does that make sense as a strategy? Not sure yet about this business. But overall, we've got an idea that our cost of goods are kind of mixed between contractors becoming more and more and employees becoming less and less as part of our billable team. The other thing to note is that if we add these things up, we can see total cost of goods sold. And we see that in Q1, cost of goods sold averaged about 70 cents of every dollar, about 68 cents of every dollar there, and 57 cents of every dollar in Q3. So that's great news. somehow that means that our structure, our strategy is working because we're keeping more and more percent of revenue over time. So these are healthier and healthier gross profit margins over time. So that's really nice to see. And that's the power of horizontal analysis. So when you combine these things, this is where the power really comes out, because now we can say, we know what our product mix is. We know that our gross profit margin is getting healthier over time. Now let's see where else we can make improvements in the business. So for example, we see our people costs are at about 22% of revenue. Is that absolutely essential for this business? Is it necessary to cut down expenses to drive more money to the bottom line? Will that stifle growth and prevent us from some of our more long-term growth strategies? That's where you got to really dig in. But at least this gives you an idea of where the money is going so that you can start to think critically about how you're going to achieve your goals. For example, what I see here in the sales and marketing budget is that we spent a good bit of money in the first couple years or first couple months, like the first quarter, but then all of a sudden our sales and marketing budget dwindled. So what's up with that? Is that part of a strategy, or is that something where we just let the gas off? Is that going to prevent us from hitting our growth goals in 2021 or next year, whatever? So again, it just gives us an idea of where we need to look so that we can implement strategy. So that's how you use horizontal analysis and vertical analysis within one business. Now remember, a couple videos back I said, when anyone tells you that their business is efficient, your first question always should be, compared to what? So what I've done is I've gone ahead and made 2 instances of 2 companies. So I've made Chris's more profitable but more volatile service business. And this is where we get to start to compare 2 businesses using horizontal and vertical analysis. So let's take a look here. We're going to use the same chart of accounts. It's the same type of business. So to keep it really simple, we're structuring all the accounts the same way. And what we're going to see here is I'm going to start by looking at the totals of income. So in Chris's profitable service business, we did $622,000 in total income in the first 3 quarters, with, again, 40% of that being project revenue and 60% of that being monthly services revenue. So I'm thinking monthly service revenue seems to be like a more repeatable style of business. It's a little bit more stable. You can count on it more. It's easier to forecast. So I'm liking that mix. I come over here and I see that this business has done less in income, but it has more of its work also. So these are 2 bad things. It's done less in income and more of its work is in project revenue. So it's a more volatile business, right? I'm going to start to look at the horizontal analysis here and kind of see 63, 22, 23, 17, 63. I'm also going to look at the absolute numbers. So 50, 10, 12, 7, 50, 20, 18, 30, 45. There's some variability there. And then I look over here, 30, 20, 60, 10, 5, 0, 15, 20, 80. That one feels a little bit more volatile to me in terms of the work. There's definitely higher numbers here. So maybe this job or this company has a higher potential at landing maybe bigger clients or better work, but there just seems to be more volatility here. Now if I look at the monthly services business, because that's really where the stability comes into play, we're seeing an average here each month of about 41,000. Kind of starts in the 30s, ends up in the 35s, and then gets to the 50s by the last quarter. If I look over here, I'm seeing 25, I'm seeing 13, and then I'm seeing 63. So it's actually ending at the same average kind of amount for the last quarter, but the volatility is just way higher. So again, also it's a lower total amount. So less income, more volatility. It's not looking great so far. Now let's look at the cost structure of the direct costs here. So when I look at this business, I see that total costs end up being 62% of revenue, and they're averaging about 65, 64% each month. Now I look over here at the more profitable but more volatile service business, and I see that gross profit is actually higher because cost of goods is lower. So in this more stable business, cost of goods is 52%, and in the more volatile but more profitable business, it's only 47%. So our gross profit, instead of being 38 cents of every dollar of revenue, we're keeping 53 cents of every dollar in revenue. So we've got an interesting situation here now where we've got a more volatile but more profitable business. So now we got to figure out what we gonna do. So now we're going to look at expenses. So I'm kind of seeing the people expenses here. Looks like we've hired some people and then fired some people by seeing these numbers kind of jump up again, and then drop back down, come back up, come back down. Over here, looks like we hired somebody, hired another person, fired somebody, maybe paid a bonus, and then fired someone. So similar volatility in terms of the people structure. It looks like we're also keeping about the same amount of people in the company. Occupancy, OPEX, professional services, I've left all of those the same for these two businesses just for the sake of focusing on the cost structure up here. Because both of these businesses have similar operating expenses and similar other income and other expenses, the gross profit reflects almost direct proportion into the net income. So what we see here is that we end up with a net income of 7%, which means 7 cents of every dollar of revenue ends up in the bottom line for this business. Now, for the more volatile but more profitable, 17% or 17 cents of every dollar ends up in the bottom line. So we ended up only generating $44,000 in net income in the business that had a higher revenue, but we generated $93,000 in net income in the more volatile but more profitable business. The question you have to answer as an investor or as a business owner is, which one would you buy? And how, if you own this business, how do you use horizontal and vertical analysis to give you an idea of where you need to invest your time and attention and resources to help the business become more stable, to grow faster, to become more profitable? And this is why finance is so fun. So thanks for watching.